Today, I bring you a company selling for $55 million, but has net cash of $112 million. That's a liquidation price of 2x current market cap for a company that isn't even close to bankruptcy. Now I'm talking about Spruce Power, a leading owner and operator of distributed solar energy assets across the United States. By offering subscription-based services to over 52,000 customers, and with 80,000 systems covered with servicing contracts, Spruce is able to make renewable energy more accessible to everyone. Just today, Spruce have appointed a new CEO, Chris Hayes, who was most recently the founder and managing partner of Alterus, which develops, owns and operates sustainable infrastructure projects for the Fortune 1000 and a pioneer in leveraging an energy-as-a-service platform for decarbonization. He was also the founder and managing partner of Altenex, which was acquired by Edison International in 2015. The company has also announced that Dr. Audrey Lee has joined the board of directors. She's currently a senior director of energy strategy at Microsoft. Both very strong improvements to the management of this company. Change in management is a nice surprise bonus today, but the real reason I'm investing in this company is the fundamentals. Let's take a look at the most recent balance sheet. Net current assets of $132 million and a current ratio of 2.8 shows the company is extremely healthy in the short term and not even close to having liquidity problems. Total assets are $895 million and total liabilities are $680 million. That gives a book value of $215 million and tangible book value of $176 million. Given total cash and cash equivalents of $173 million, that gives us an enterprise value of $501 million. Straight away, it looks like a good opportunity because of the book value being over 3x the market cap. But that's not all. You might be wondering where I got that net cash figure of $112 million that I mentioned at the start, because total liabilities are at $680 million, which doesn't add up. However, this is where price and value start to differentiate. Spruce's $618 million of debt, which I admit is huge for a company this small, is non-recourse debt. What this means is that if the borrower defaults, the issuer can seize the collateral but cannot seek out the borrower for any further compensation, even if the collateral does not cover the full value of the defaulted amount. Because the debt is non-recourse, there is essentially zero risk of the company going bankrupt. If Spruce cannot afford to make the repayments on the debt they've taken out to acquire their solar assets, they simply cancel the debt and give back the solar assets. This is the worst case scenario for the company. If that happens, there is essentially no company left, which of course is not a good thing. But if that is the worst case scenario and that does happen, let's have a look at what's left over. The $618 million of non-recourse debt is cancelled and the solar assets are given back to the lender. The company would then have $62 million of liabilities and $173 million of cash, as well as some other smaller assets, but let's just focus on cash as it's liquid. The net cash in this scenario is $112 million, giving us that figure I mentioned at the start of the video. The lack of awareness from the market around this non-recourse debt, largely due to how small the company is, has created this big disparity between price and value. The market would eventually realize this and price will catch up to value, which from here is about a 2x return. Again, this is worst case scenario. Now let's look at the income statement. Revenues are up 2.5x to $80 million in 2023 compared to $23 million in 2022. Cost of revenues are about 45% of revenues, which then gives a gross margin of 55%. SG&A expenses have reduced significantly despite higher revenues, which is a great sign that the company is becoming much more efficient in its day-to-day operations. And then if we take out the one-off litigation settlement, which was related to the SPAC deal when the company first came public, we have an operating loss of about $10 million. which, although isn't good, is a huge improvement on 2022's operating loss of $60 million. That is a very promising sign for an early stage, capital intensive company like Spruce. The improvements in operating income are expected to continue, as Spruce have actually said they expect 2024 operating EBITDA in the range of $68 to $86 million and 2024 adjusted free cash flow in the range of $0 to $5 million. So wrapping up our analysis, Spruce Power emerges as a compelling opportunity for value investors. Perhaps the most compelling aspect of Spruce is its potential for growth. With revenues soaring and operational efficiencies improving, Spruce is poised to capitalize on the growing demand for renewable energy solutions. But the value truly comes on display when you look at the balance sheet, which is well positioned to weather any storms that may lie ahead and suggests a worst case scenario of a 2x from these prices. I hope you got some interesting insights and ideas from this video. If you did, please leave a like and subscribe to my channel. I'll see you in the next video.